Hi, this is John Dowdy, and I'd like to give you a review of the stock market for the week ending June 21st, 2013. Last week, the bear really mauled the bull, and the bull is in pretty serious condition. We will take a look to see how badly he's hurt and how he might recover as we go through this review. After viewing this, if you'd like to have more data, please come to my website, www.superchargedretirementIncome.com. What we'll do is look at two time periods. We'll look from the short to the intermediate time frame first. Then we'll take a long-term view of the stock market. Okay, let's look at SPY, which is the ETF for the S&P 500. As you can see from this plot, we've been in a green uptrend channel since November of last year. We went above that channel in early May, but then came back, and last week, for the first time, we broke below this channel. We had a breakdown. We not only went through the 50-day moving average, which had been support for several times in the past, but we also broke down below the green uptrend channel. Very significant event for that breakdown. Where do we go from here? We look at resistance and support. We have resistance up at the prior lows and at the 50-day moving average. So the resistance will first come in at around 160, and then if that's broken, the 50-day moving average is around 162. So we should see significant resistance at 160. We may see a throwback to the 160 level and then down further. That would not be unusual. Support comes in at the previous low, which is 153.55, and if that's broken, then we can go all the way down to the 200-day moving average, which should be a very significant support. That would be at 150.68, and if that's broken, we're looking at this low right below the 200-day moving average as the last support before a big drop. This last support is at 148.73. So we have three support levels down below where we are now, and we'll have to see which ones of those hold. We could immediately go back above, so this would be a false breakdown if that occurs. But if we keep going lower, then I would expect to go to the first support, maybe get a bounce, then go lower to the next support at the 200-day moving average. 200 moving average will really be key to what this market does. So if we look in the short to intermediate time frame as a summary, the market for sure had a major breakdown after the Fed meeting. The Fed meeting came out on Wednesday. Bernanke talked about tapering, and the market crashed. Crashed through the uptrend channel and also the 50-day moving average. But don't forget, we still have excellent returns for the year. The market is up about 11%. So this is excellent still for the year. But these returns are in jeopardy now, at least for the short term to the intermediate term. The support levels that we identified must hold, or we could go even lower. If the market moves back above resistance, as we have talked about, 160 to 162, then we're in recovery mode. This was a false breakdown, and you don't have to worry very much. But if we keep going lower, then we need to look at support. And if these support levels don't hold, then we have big problems. The first support, 153.55. Then a major support at 150.68 at 200-day moving average. And finally, 148.73. If we miss 148.73, we could go all the way down to 140, which is the next low, the next support. And that would be a 17% correction from the high. That's very near bear market territory of 20%. So let's hope we do not go down to see that major correction. So in the near term, and you need to use extreme caution. This is a dangerous market right now. You should wait and see if we get a bounce or if we get a breakdown to further levels. Now, let's look at the longer term view. On the longer term, this is months and years, the market still looks very good, actually. As you see, we made a high back in 2007, and that high has been in place up until this year. And we broke out finally in 2013, and we went up to high almost to 170. And then we had a throwback to the breakout point. Doesn't look bad at all. This is the throwback that we've just been talking about. So from a very long-term point of view, the market is still healthy. We're still in a bull market. This is a throwback that is not unusual. So if this support, long-term support holds, if 157.47 holds, then we should bounce higher over the next few days and weeks. And if that happens, then we're still in a bull market, and without any problems, we could go significantly higher. So we're at a critical junction of the market. The breakout above the 2007 high is still in force from a long-term point of view. But on the short term, the market has suffered significant damage. The key support here for the long term is 157.47. If that holds, then we're in good shape. If that is broken, then watch out below. We could go all the way down to 135 to 140. And remember, 135 to 140 is the level that we talked about over the short to intermediate term. So if this level does not hold and we keep going down, then it is possible over the next few weeks to months that we may get all the way down to 135 to 140, which would be about a 17 to 20% correction, in which case then we'll have to look to see if we're really going to go into a bear market or not. So be cautious. Let the market action guide you. Not speculation. Wait for the market to tell you what it's going to do. So a legal disclaimer, the contents of this video are strictly for informational purposes and should not be construed as any investment advice. I'm giving you my opinion and my opinion only, and you and only you are responsible for your investment decisions. Investment involves risk of loss, of course, and past performance is not an indicator of future profits. So good luck next week. Keep a close eye to the market. Thank you for viewing. And as I said, if you'd like more data, please come to my website, www.superchargedretirementIncome.com. Thanks.